All right, guys, today we're bringing you a couple great solutions for all those buyers who want to put in offers, but don't want to have a sale contingency messing that offer up.
You better get fired up.
All right, happy Friday, my man. How you doing?
Hey, I'm great. Fired up. Let's go.
Yeah, you're speaking my language, baby. I like that. So we've got Nate Jomaa on. He is our expert lender, helps our entire team with all the different lending issues that we have. Any client who comes in and they're talking numbers, he's our guy. So one thing that he and I were talking about is, hey, we've got all these buyers who want to come in. They want to put offers on homes. But the scary part of putting that offer in on a home is, what if I don't get my home sold first? Right now I got 2 mortgage payments. I don't know if I want that. I don't know if I'm going to be approved for that. So I'm gonna make that offer look like a big red flag saying, hey, I got to sell my home first. How do we get rid of that red flag, but also add a bit of protection and maybe give that buyer what they need to feel comfortable with their home as well? So Nate's coming in today and he's got a couple great solutions depending upon where you're at as a buyer. Nate, take it away, my man. I'm excited to hear these.
Yeah, for sure. So there's 2 primary strategies that we're looking at for that. So the first one is getting a bridge loan, and we'll deep dive into that here. I'm sure you've got some questions on that. And the second is a home equity line of credit as a tool that can be used in 2 different ways to help bridge that gap or to help eliminate a sales contingency for you.
I like that. So we're going to talk about bridge loans. I just want to tell everybody, a home equity line of credit. You may have also heard HELOC before, right? It's just the first letters of all those different words, and boom, you've got a HELOC. So if you've heard of a HELOC before, that's exactly what Nate's talking about. Yep. Let's go with the bridge loan first. Tell me a little bit about what it is and how it would help me in that situation.
Sure. So a bridge loan basically does exactly as it sounds. It bridges the gap between you having to sell that house to pull out equity to purchase your new property. So it basically works like this. You have your existing home that in theory has equity in it, and you can get up to 90% loan to value. So let's say that you have a home that's worth $500,000 and you only owe $200,000 on it. Well, we can basically go up to 90% of that value of $500,000, whatever that might be. And you can pull all of that equity out right now. So you can use that for down payment to buy the new loan down even more. You can use that for basically whatever you want in terms of that new house. You can use it for closing costs, whatever the case is. You have that existing mortgage. Now you've got this new mortgage. How do you get that money out? Well, that's what's called a bridge loan. So it's a third mortgage that you're basically getting, but it's a short-term mortgage with a low interest rate that you're only making interest-only payments on. And then once you have that other property, your departing property sold, you pay off the lien on that one, obviously. You pay off the bridge loan. And then whatever you have left, you can now put into the new property. Whether you just want to take that cash and apply it as a lump sum, if you want to do a mortgage recast, which we can talk about if you want to dive into that, you can do whatever you want with that money, but it helps you not have to sell property A to buy property B and gives you that equity right now. The caveat is you have to qualify for all 3 loans.
Gotcha. Okay. And just to go over numbers, again, $500,000, let's say your home is worth that, you owe 200. So you've got 300 grand to equity. What Nate's saying is you can take up to 90% of that $500,000 value, which is 450. So if you owe 200, you'd have 250 to work with there. And that's incredibly helpful, right? So I thought that was phenomenal. Now, unless you've got more with that one, let's start talking about a HELOC and how that differs.
Sure. So with a HELOC, there's 2 strategies there. You have equity in your existing property, just like we talked about in the bridge loan. You can pull that equity out and you can use that again toward your down payment, toward your closing costs, toward whatever the case might be. So you can either do that strategy, or if you want to pull out a lump, like a huge sum out of your existing property, let's use the same example. Let's say that you want to buy a property that's only, say, $350, and you have $250,000 in equity that you can pull out. Well, you can put $250 down and only finance that $100,000. So that helps your new mortgage be significantly less, which helps the DTI, debt to income ratio. That's typically what a sales contingency is. It's either I need the equity on this to put down, or I can't float both of these loans simultaneously. So it gives you the ability to reduce or minimize the debt on the new property by pulling that cash out. You have to do this premeditated, though. You cannot get a home equity line of credit on a home that is for sale, right? So if you know that this is the approach that you're going to take, and you're working with the Rosen group, and they're telling you, hey, we're going to make an offer on this house, but your house isn't for sale yet, you've got to talk to us and let's get the home equity line of credit lined up first.
Yep.
All of these things are very good tools, but they have to be used in the right way, or else they could really become bad tools.
Yeah, and I'll tell you too, just my general opinion doesn't have anything really to do with this topic so much, is most people who bought homes, say 2-3 years ago or more, which is the majority of homeowners, you've got plenty of equity in your house. If you go locally to Seacoast Bank, we got a home equity line of credit through them, and it cost us nothing. They cover all those fees. And now we've got, I forget what our home equity line credit is, but it's essentially like an open credit card, right? But here's the difference. I have a much lower interest rate. I forget what the interest rate is. It's not great, but it's like 8 to 10%. And now if I've got some emergency issue, let's say my car goes out, right? And a car loan is going to, I don't know what a car loan even is, but let's say it's a horrible interest rate. And I don't want to use my credit cards because most of them are horrible interest rates too. Now I can look at my HELOC and say, hey, I've got a much more affordable, when it comes to interest rate, a much more affordable option here. And it's one more layer of security. So honestly, whether you're thinking about doing this or not, I think going with a bank who's going to charge you nothing and getting yourself that option is maybe not for everybody, but it's a good option for a lot of people.
For sure. Absolutely. Yeah. I have a home equity line on my house too. I don't think it's a terrible thing to have on your house, even if you never use it. Just like your credit cards, if there's no balance on it, you're not making a payment. You only pay on what you're using.
Yep. So guys, I'll tell you, if you were my client and you brought this up to me and this was a challenge, I would say, hey, let's schedule a time and we'll talk with Nate so that A, you can feel comfortable knowing what's going on and make an intelligent decision. And B, I understand how to structure the offer to protect you best. And you would sit down and have a conversation. And in a lot of these cases, that conversation is going to be no more than 10 minutes, right?
Sure.
He's going to ask you very specific questions about yourself, your situation, what are you trying to achieve, whatever, right? To get the answers out of you so that he can best give you advice. And then he's going to tell you the pros and cons of that advice. And if the pros outweigh the cons, you can move forward with it. But I think when people hear about these things, they think it's a way bigger, way more complex activity or task than it is. It's really not that challenging. And, you know, listening to a video like this, there's a lot to it. It sounds complex, but once you get in front of Nate, he takes a lot of the complexities out because he's not giving you every scenario like we are in a video. Right. He's looking at your scenario, and instead of having to talk about all 37 options, he can talk about the 3 or 2 or whatever it is that makes sense for you. So I just point that out because I think a lot of people, when they hear this, they think, oh, that sounds really overwhelming. And it's not. Nate does a really good job of making it very clear, educating you first. And then if it's something that makes sense, we can move forward with it. Nate, is there anything else you'd like to add?
No, those are the two big strategies. I mean, I don't know if you've got some questions that I can dive into on those two things, Joe, but if anybody has any questions, make sure you leave them in the comments. Even if you're watching this video on a replay, we'll be happy to answer those for you. But those two strategies to prevent you from having a sales contingency are huge.
If you could, I mean, if I'm hearing this as a potential buyer who's in that situation with another home, I'm thinking, okay, that sounds great, but what are the negatives? So tell us some of the negatives that I would want to consider before moving forward with one of these two options.
Sure. So starting with the bridge loan, I would say that the big negative is that you're carrying 3 loans for a short period of time. For some period of time, whether it's a month or 2 months, you've got your primary mortgage, you've got the bridge loan, and now you've got your new mortgage.
Yep.
Right. The positive to that is that you know that if you can manage to afford those, even if it's outside of your personal budget, if you're qualified for that, it's a very short-term solution that prevents you from having to juggle the sales contingency and the contract.
Yep. Yeah, I would also say, and this is kind of how I verbalize it to my clients, what are the closing costs involved? Just roughly on a specific price.
So they're inexpensive and they're financed into the loan. So it's a $500 origination fee, and that's financed into the loan. And like I said, it's a 6-month balloon term with interest-only payments. and the rate on that is actually pretty low. So if your loan to value on that is less than 80%,
Yeah.
your rate's only 4.5%, and it's interest only.
So $500, that's the only cost that's involved with
It's a
that?
$500 origination fee.
Okay. So I will tell you this, I've never done a bridge loan with you, but I did speak with another lender one time, and it was thousands of dollars. So my discussion at that time with that buyer was, you've got to decide which is more convenient for you, keeping those thousands of dollars or being able to put an offer in that's not contingent upon your sale, which increases your chances of getting the home. And this was 2-3 years ago when the market was smoking hot. And that meant more than it means today, which even today it still means a lot. But if you're talking $500,
well, the origination fee is $500. You're going to still have some title fees, some
okay.
whatever,
So
whatever those things are. I mean, those are going to be the same regardless. But the loan cost itself is only $500.
So what are you looking at as a buyer for the total cost roughly?
I don't know what the title costs are, so it's hard to say.
Okay.
I would say it's probably not very much. It doesn't take them long to do a quick title search. You don't have to buy title insurance because you're only going to have the loan for a couple of months.
Yeah. So I would say this, when I'm speaking with that buyer and having this conversation, to me, and this is how a lot of these conversations go in real estate, because there's never an A+ solution, right? It's always, here's a B+ and here's a B+. There's pros and cons to both. Which one do you like better? And so here I would say it solves the convenience factor. It solves your ability to be able to put in an offer without a red flag on it. It solves your ability to get your offer accepted at a higher conversion rate, but it's going to cost you some money. So the question is it worth that money? If you say no, great, but then you've got to know your odds of getting it accepted, the convenience factor, all that go out the window. If you want the convenience and to get rid of the red flags, you got to pay a little bit of money for that. There's no right or wrong answer. It's just, here are two other solutions that are going to offer you some paths forward. And like I said on that HELOC, not all banks do it for free. In fact, I don't know of any others other than Seacoast that will do it for free. But Seacoast, at least with me, I don't know if there was some special reason or if it was a promotion or what it was, but it was free to get that HELOC, and it's incredibly helpful to have it there. I haven't had to use it, but man, it's nice to have it there if I do.
Yeah, no, Seacoast is great. I don't know how they do their home equity line, but we can do a home equity line for you as well. And we can close in as little as 5 days on that. It's a very quick process. But one thing to remember with a home equity line, we're talking about it being a great tool for you, and it is, period. But it's not a mortgage product per se. So as Joe is saying, your rates on a home equity line of credit are going to be elevated. When you hear that you're getting a home equity line of credit and the rate's 8, 9, 10%, a lot of people will say, oh my goodness. But you got to remember, if you have a credit card in your pocket, and a lot of us do, our rates on our credit cards aren't that low. And essentially, we're looking at the same thing. But instead of just your credit being the collateral, you're looking at your credit and your home being the collateral, right? Yeah. So you're getting a credit card where your home is the collateral on that credit card. So an 8, 9, 10% rate on a credit card is a screaming good deal compared to what you normally would pay on a credit card, which might be in the low teens.
Yep. Well, guys, I appreciate you listening. If you've got any questions specifically for Nate on this, leave it in the comments and he'll get back to you. Not a problem with the answer to that. I appreciate you joining us. And if you do want to get in and talk to someone, I can't suggest talking to Nate enough, man. He is not, and this is why we use him, he is not a salesman. He is absolutely an educator. He has told people before, I don't think that this thing that's going to make me money is intelligent for you to use. I would do this instead. And for that reason, we love to continue using him with our clients. He's a great educator and a great resource. So Nate, I appreciate you being with us today, my friend.
Of course. My pleasure.
All right, guys, have a phenomenal weekend. Take care.